Welcome to Copper's latest opening bell report. The story today starts with the Federal Reserve. The chair admitted that policymakers are essentially walking blind into the next meeting with little data clarity to guide them. Naturally, markets didn't love that. Investors had been hoping for something more constructive, some kind of forward guidance. Instead, they got uncertainty. Risk assets fell across the board, crypto included. Copper's research desk flagged a structural pattern earlier in the week, suggesting Bitcoin was on the cusp of retesting the $120,000 zone, with $108,000 as a potential low point if bad news hit. The latter happened as of Thursday morning. Now, with sentiment fragile and the ongoing US government shutdown adding even more pressure, we've extended the analysis to see how similar setups behaved in the 30 days leading into the next FOMC decision meeting in December 2025. Here's what's interesting. Bitcoin's current structure mirrors almost perfectly what we saw a year ago. Strip away the headlines, and the last week or two of trading have followed an almost identical pattern to late September and early October 2024. The method's straightforward. We take Bitcoin's current short-term price action, scan historical data for segments with the same rhythm, shape, and volatility, then score each one by correlation. The best matches are grouped to see what typically happens next. Those correlations between 0.85 and 0.9 for the 7, 14, and 15-day windows. That's unusually high for Bitcoin. Once you stretch to 21 or 30 days, the similarity fades fast. Correlations drop into the 0.4 or 0.5 range. So what we have is a very strong short-term alignment, not a long-term cycle. When we average what followed after these high correlation periods, the results skew positive. Historically, Bitcoin gained around 2% after 5 days, 4% after 10, and roughly 5.5% after 15 before levelling off. Downside moves were typically small, just 1 to 2% below the start point. Some of the strongest analogues listed in our internal scoreboard even delivered gains over 20%, but those are outliers. Broadly, the data suggests a mean forward drift of around 4 to 6% at 10 days and 6 to 7% by day 15. That clustering makes sense. It tends to coincide with post-flush recovery phases that often mark the start of a fresh uptrend. Volatility, momentum, even RSI, all very similar to last year's playbook. Still, there's a catch. Bitcoin closed below $111,000 and briefly tagged $108,000. That hits the lower edge of our modelled range. The pattern isn't broken yet, but it's on shaky ground. If we see a sustained close below that $108,000 level, the correlation would fully unwind. Stay between 108 and 111k range, and the setup remains technically valid, just with less confidence. From a trading perspective, that translates to a 1 to 2.5 risk-reward profile, about 2% downside versus 5 or 6% upside. So yes, history rarely repeats exactly, but it often rhymes. Bitcoin's rhythm right now is echoing an old beat, one that typically resolves higher before fading. Above $111,000, the structure stays alive. Below that, the analogy's gone. Until that line breaks, the probabilities still tilt, ever so slightly, toward continuation. Thanks for tuning in to Copper's Opening Bell. For more detailed information, don't forget to download our full report. See you next time.